Hello, and thank you very much for joining us today. I'm Jennifer Watson. I'm with my colleague Adam Jekyll, and we're going to talk to you about what to do with your money in volatile times. We're first going to talk about the market, give you a summary of what's happened to try and make sense of it all for you. And then we're going to be providing specific financial planning tips that might be able to help you and your portfolio.
Thanks, Jennifer, and thank you all for attending this afternoon to our webinar. Before we dive into things, I want to touch on a few house cleaning items. The first of which is at the bottom of your Zoom meeting window. There's a Q&A tab. If you'd like to submit any live questions to us during the webinar, please click this tab and submit them. We will be hosting a short session towards the end of the presentation where we will be addressing these. As well, towards the end, we'll be providing a live poll to gather your input about the presentation and how we can improve. With that out of the way, let's kick things off, Jennifer.
We are seeing so many different headlines out there right now, and it feels like more so than ever, there's so much media attention, there's so much coverage on the markets and COVID-19, and the headlines can be very overwhelming, and the volume of news is very overwhelming and can be very confusing. You know, we're seeing things like buy these stocks, do this, don't do that. So Adam and I today are going to try and make sense of everything that you've heard right now and try and cut out this media noise for you.
Exactly, and a lot of these headlines are playing to investors' emotions, and one of the strong emotion being fear. And so what we have is we've outlined a volatility index, also termed as the fear index. What this is an expected price fluctuation for the S&P 500 for the next 30 days. So the key points to take away is this is expected for the next 30 days, meaning it's a leading indicator. So when looking at the chart, we can see before coronavirus really started, it was hovering at 12.75 points. And at the peak during middle of March, it went all the way up to nearly 83. So what was expected was nearly 7 times more volatility in the market than normal. Where have we gone since that peak? Well, things have dropped off drastically, down to 41. So what we can take away from this is investor sentiment and confidence is returning to the market, and the next 30 days is expected to be less volatile than the 30 that we've already been through. With the 30 that we've been through, how has this affected the S&P 500? Well, we have had highs and we've had lows and we've had very notable single-day moves. So in February, the S&P high was almost 3,400. Over the course of the next 4 weeks, it dropped to 2237. That's nearly a 34% drop in that 4.5 week period. That's a lot for investors to stomach, seeing their value of their investment decline. Where have we gone since that bottom? Well, if investors were able to stay invested and stomach the market fluctuation, they would have received a substantial rebound. It has climbed back up over 2870 through that period. That's over a 28% increase over the 4 weeks since the bottom. That's quite significant. So this movement doesn't come in uniform days. It comes with some large days and some small days. The notable days are 2 largest negative days, being negative 12% and negative 9.5%. These rank 3rd and 6th all-time single-day moves on the S&P 500. On the flip side of that, we've had very substantial positive days as well, being above 9% twice, which fall into the top 10 largest positive moves of the S&P 500 throughout its history. So when we want to expand our view, not just to the S&P 500, but international, Canadian, and US stocks, we see red across the board. When we want to dive into the segments of those stock markets, being the large cap versus small cap, growth versus value, we see that small cap in every geographical market has been hit harder than those large cap stocks. Now, why is this? Well, small cap stocks inherently carry more risk in them being a small company. Now, small companies tend to react stronger to movements in the market and the economy. So as we've seen a dip over the first quarter, those small caps will move the greatest amount. Now let me draw your attention to the bottom right quartile, real estate and fixed income. Global REIT, meaning Global Real Estate Investment Trust, was impacted negative 22% over the first quarter, quite substantial. And then finally, we get into the green. We have 1 month T-bills, short and intermediate term bonds, and global bonds. And we've seen a positive percentage having been invested over these instruments through the first quarter. Now, with so much red and a very concentrated position of green on the screen, shouldn't we be transitioning all of our assets to those short-term bonds and intermediate-term bonds? Well, let's look at the results. The growth of wealth over a 1-year period ending March 31st would say that we should be invested in Canadian bonds and T-bills, those being the two highest performing asset classes, with Canadian stocks and global real estate having the worst performing years. Now, this is an investment horizon of 1 year. Most investors are invested for far longer, 5, 10, 15 years, and hope to earn returns over the market during their full investment horizon. So let's expand things a little bit. And we see the graph has essentially been flipped, with now T-bills and Canadian bonds being at the bottom, earning the least return over the 10-year period, with Canadian and US stocks earning the highest return. Very important to see that being exposed to the volatility and the fluctuation of stocks gives investors the opportunity to earn a higher return over a long time period. Given the 10-year time period, the US have more than tripled in value, as well as the Canadian stocks have more than doubled in value. Quite significant gains, even with a pandemic on the end of that.
So we want to give you some more clarity by putting this into perspective from previous market events and market declines. We'll target two of them, which you might remember would be the terrorist attack in 2001 and also the financial crisis in 2008. Now, I'd like you to think back to those timeframes and think about your account size was likely a different size than it is today. Think about the stage of life you were in. Perhaps that was very different too than today. And think about how those declines made you feel. But then how we had such positive returns following those major events. Now, right now, yes, there are some added factors. There's the fear of the health risk that exists right now, which is what's causing the market decline. And that fear, as well as the change of environment that we're living in right now, can add to the stress that we feel, which adds to the stress we might be feeling in our portfolios. But again, looking back over time, these other major events that have occurred and affected your portfolio, we've always seen significant recoveries post them. So taking, for example, the terrorist attack that happened in 2001, right after that event, the following month, if we were to take that for a year out, assuming a portfolio of 60% in stocks and 40% in bonds, we've used different market indexes to create what would have happened. So what did happen was a negative 1% return the following year. But 3 years after the terrorist attack, a 40% return. 5 years after, 81% return. Similarly, in the financial crisis, what we saw was, 3 years after, 12% return. 5 years after, 47% return. So we're not saying exactly what's going to happen, but hopefully looking back historically on these other major events and then seeing such positive returns following the events will provide you with some peace of mind and comfort.
Exactly, and we want to have a big picture view of the market and what we can expect based on past events. A lot of the headlines now are transitioning from market activity to economic activity. So what we want to do is outline different recessions as identified by the National Bureau of Economic Research that looks at them at the peak of the business cycle and then projects the next 24 months out. So we see a large number have earned a positive return over that 24-month time period, with the exception of the Great Depression in August 1929. You would have had a very, very probable chance of ending those 2 years in a positive position, having staying invested. And that's what we want to illustrate here. We don't want to illustrate any knee-jerk reactions to short-term market and economic events. We want you to stay prepared to stick to your long-term objectives by not exiting the market and possibly losing out on those positive returns.
So what does this all mean for you and your portfolio? Well, it's a good time to look at your portfolio. Make sure you have a well-designed plan that can withstand times of volatility right now, as well as the times of volatility we're going to have in the future. Also, in times of volatility, there's some specific financial planning tips that we have for you. So we're going to talk about 3 tips. The first is tax strategies. The second is increasing contributions. And third, we'll discuss rebalancing. Tax strategies. So the first one we're going to discuss is tax loss harvesting, also known as tax loss selling. To help explain this example, we've outlined on the screen, you'll see we have 2 different investors. So if you have a non-registered account, this strategy right now and in future times of volatility might work for you. So Investor A. So Investor A bought Fund 1. Let's say they put in $50,000 into the market. That fund now has grown to $100,000. So there's $50,000 of capital gains. For the purpose of this example, we're not going to count for any other distributions that happen within the funds, any other inflows, outflows. So simple, we've said, okay, so there's $50,000 of capital gain, of which half of that gets taxed in the year you make that sale. So half of it at the marginal tax bracket. For our example, we're using 40%. That means you're paying $10,000 for that capital gain. Investor B. Investor B had the same fund where they had a $50,000 capital gain, but they also had Fund 2. And in Fund 2, we're assuming that, let's say they've bought in at $50,000. The fund, based on current market volatility, has decreased to $20,000. We have $30,000 of a capital loss. Now, a capital loss, half of it, can be applied either 3 years prior. So you refile one of your past 3 tax returns where you had a capital gain. So you can refile it and claim that loss to offset that gain. Or you can carry this loss, capital loss, forward indefinitely to offset a future gain you will have in your account. For the purposes of our example, we've assumed, though, that the gain and the loss happened in the same year. So as you can see on the screen, we have $50,000 of a gain, $30,000 of a loss, so $20,000, half of which would be taxable to the investor at the 40% marginal tax bracket. Therefore, Investor B is paying $4,000 of capital gains tax, as opposed to Investor A, who didn't utilize tax loss strategies and is paying $6,000 more in tax. So now this strategy, again, it works if you have a non-registered account, but it also primarily only is recommended when you are able to sell a fund at a loss, if it's a broad equity diversified portfolio. If you sell that particular fund at that loss, so you harvest it for the tax purposes, and then you move that investment laterally into a fund that's very, very similar. Therefore, you're staying invested in the market, and you're harvesting the loss, but it's not almost like a true loss because we're staying invested in the market. So now, because we're invested in the market, we can continue to, hopefully, when the market starts to recover more, we've reaped that uptick. So we've had that tax advantage, but we're still staying in the market. So definitely something to consider. Speak to your advisor if this is something you haven't done yet, and it might be something that works for you now and, again, in times of future volatility. The second tax strategy we're going to talk about is your RIF minimum withdrawal. So if you have a registered retirement income fund, every year there's a minimum that you have to take out of this account. And there's a lot of tax strategies that come into play for retirement planning, but specifically, we're going to talk about the fact that the Canadian government this year has reduced the minimum that needs to come out of that account. So they're trying to give us an incentive because of the market declines right now. So if you have this type of account and you haven't already taken your minimum out, this might be a strategy that you would like to explore. This is something that you would want to do if, let's say, you don't need the money. So you don't need as much coming out of the RIF account, or you have other sources to fund the money you need to fund your lifestyle, and therefore more money can stay in the RIF, and then it's staying invested in that tax sheltered environment. But different considerations would be your age, your health, the size of your registered accounts, if you're married or not, and which other type of investments accounts do you have, and what do you have in there that's owned, because it's the balance of where's the best place for your money, and then also why the account size, health, age, and if you're married is relevant is for estate tax planning. So it's creating that balance. So again, it's very specific, but if this applies for you, definitely worth exploring to see if that's an opportunity. The second financial planning tip is increasing contributions. So yes, it's increasing contributions into the equity market is what we mean. So if you have extra capital that you can part with for a long period of time, the second you have that money is when you should be investing it into the market. So for example, let's say you have a lump sum of money, but the purpose is to buy a cottage very soon. Not the time to be investing that money into the equity market. But if it is for the long term, there's two ways of helping determine what's that amount look like for you and what's the best amount to be contributing. So the first thing we want to look at is your budget. So can you afford to meet your current lifestyle needs? And we always want to have a bit of a buffer and a sensitivity thrown in there when you're looking at your budget, but especially right now, not only the market's volatile, but our working conditions are very volatile. So what's that safety net look like for you? For our business owners, it's, what's your company's financial forecast does it look like? And will you be taking maybe you're not taking as much of a dividend or a bonus this year, so that's going to affect your budgeting. So once you've looked at that, you also want to be looking at your cash flow projection, so your financial forecast for the future. And that can be a huge part that helps determine how much should we be contributing now. Because if we're looking at those financial forecasts, so you're wanting to get to this goal in the future, well, it helps us determine in today's dollars how much we should be contributing. So maybe it actually tells us that, yeah, we should stretch ourselves and just push a little bit more into our equity investments because it's going to help us achieve our long-term goals. So really having those forecasts done and understanding it is really going to help provide a lot of clarity when making those decisions. The last piece about increasing our contributions into the broad equity diversified markets is right now is maybe you have a little bit of extra cash because our spending habits have changed. So for some people, their adult children have maybe moved home, so there's increases in our household expenses. But what we found is on average, there's actually a lot of savings right now in other ways because of the fact that we're staying home. So those additional savings, maybe you're able then to have an automatic contribution. So let's say maybe a bi-weekly automatic contribution of a smaller amount of money that you can afford to go into the equity market, even if it's just for a shorter period of time. But again, when you have the capital, it's the time to invest it, and definitely look at those forecasts to help determine that right amount. The third financial planning tip we're going to talk about is the concept of rebalancing. In order to actually talk about rebalancing and understand the amount of money we should be rebalancing, we want to first address the fact that you should have a written financial plan. If you have a written financial plan, what it does is it provides clarity, it gives you discipline, and it really helps plan for your future, but it really also helps in times of market volatility because we've planned for volatility in our financial plan. For our retired individuals, Your financial plan should have outlined, for example, where you're getting your retirement spending money versus your long-term investment money that you need to have growth. So, for example, you want to be taking money that funds your lifestyle through something that's a bit safer and not selling the equities when they're down to fund your lifestyle needs. So again, having this in the financial plan would provide that comfort when the portfolio is lower than it was not long ago. Also in our financial plan, you will have an investment policy statement. The investment policy statement is going to outline what your portfolio should look like. What's the big picture design? And it also says your asset allocation. So what's the mixture between stocks, so equities, and bonds, fixed income? It will go into the geographical diversification that you should have, different sectors, things like that. But for the purposes of our example, we'll just keep it high level at equities, fixed income. So let's say your target asset allocation is determined from you by a very comprehensive discussion with your advisor, which outlines both your past investment experience and what your goals are for the future, because there is that balance there and trade-off really of the amount of risk you should and need to be taking in the portfolio, your comfort level, and then how do we go about taking that risk to get the growth in the safest possible way. So now we've determined your asset allocation. We're going to assume it's 70% is suggested to be in equities and 30% is in fixed income. Well, with the market fluctuation, your current asset allocation now is 64% in equities and 36% in fixed income. So what we suggest is taking 6% of the money from the fixed income portion and actually buying more equities, rebalancing the account. Now, we've always looked at the academic research of investing and looked at what is the best, how to go about making the best decisions for the portfolio. There's nothing that supports when's the best time to rebalance, but the research does show that you should have a target asset allocation and you should rebalance accordingly when you're offside. The percentages of when you're offside, it is based on risk tolerance and other factors, but basically right now, based on our example, it made sense to rebalance, and that's what's going to help your portfolio the most in the short term and the long term. The asset allocation is one of the biggest factors in determining your overall portfolio performance. Now, I'd like to address that if you are feeling very uncomfortable right now with the market, with the volatility, it's something that maybe it's your stage of life that you're in or your account size, but for whatever reason, you're not comfortable like maybe you have been in the past with market volatility. I would encourage you to speak to your advisor. Now is the time to have those open conversations. Make sure you have your advisor that you can trust and that you feel comfortable expressing yourself to, because they should be aware that you're not comfortable. Your asset allocation is something that does change. It can change with your age, stage of life, if there's different significant changes to your wealth. So for example, maybe you sell your company, you have an influx of cash, that can change your asset allocation, things like that. Those aren't definitive times when your asset allocation changes, by the way, but they are times that typically would prompt an advisor to assess it and see if it should have a change or not. Now, if you're feeling uncomfortable, you want to have that dialogue with your advisor, perhaps you don't want to have as much equity in the future because of how it's made you feel this time. And you've looked at your cash flow projection to make sure that making a change to your asset allocation makes sense for you. I would encourage you not to reduce the equity exposure in your account right now. While times are so volatile and the markets are down from where we last and not long ago saw them, you don't want to be reducing the broad equity exposure you have. You can make changes within the equity portion, but don't reduce the equity exposure because that's going to really significantly hurt you if you do that. So again, if you're not comfortable, express it to your advisor, and then maybe in the future, there's an opportunity to make a change, but don't make significant changes such as that right now, but other changes you can be making in your portfolio.
Excellent. Thank you, Jennifer. And we have had some questions come in over the course of the presentation. The first regarding RIFs. The question is, when should I not be taking advantage of the minimum RIF withdrawal?
Yeah. So let's say you need all of the money that's coming out of the RIF account, then you might not want to reduce the minimum if that's the best place to take the money from. If you've already maximized your tax-free savings account, for example, and you've invested that in equities, then you might not want to reduce the minimum. But again, it really does depend on your other accounts, your size of your accounts, your stage of life, and then knowing if that's the best place to keep the money or should some of the money be going out to be utilized better in a different vehicle. So speak to your advisor and they'll be able to help navigate that for you and also implement this change if that's something you'd like to do.
Excellent. And another question that came in, when should I consider changing my asset allocation?
Yeah. So as I mentioned, it's a good time when significant things in your life change. So either maybe when you're getting closer to retirement, you're in retirement, you're later in retirement. If you have maybe you've inherited money, things like that. But again, those aren't definitive times. We don't necessarily change our asset allocation when we retire. But those are things to consider. And again, just prefacing it is don't reduce the equity exposure right now. If that is something that you're going to be doing in the future, I would wait on that one. But have that conversation because it is very specific to yourself, your risk, and your needs.
Excellent. And the last question that came in, uh, small cap or large cap, which is better?
Yeah. So neither one is better over the other. They're different. They have different purposes, and I think a portfolio should own both of them. So, as Adam mentioned, is in smaller companies, they tend to be more risky. So, right now, we're seeing them at a bigger decline than larger companies. But historically, what we've seen over time is that smaller companies do outperform larger companies. So, I think there's definitely a balance that you can have in your portfolio, but there's certainly other characteristics that come into play outside of just large versus small. So, you want to be considering everything when you're looking at the portfolio.
That's fantastic. And I think what's echoed most through the financial planning tips and these questions and answers is talk to your advisor and
Mhm.
don't make any sudden knee jerk reactions. Go through your cash flows and what the advisor has to say as well.
Yeah.
Now, concluding the presentation, we have a live poll that we'd appreciate you taking the time to fill out as Jennifer has some closing remarks for us as well.
Yeah. Well, thank you very much for listening in today, and we appreciate you filling out the survey on the screen right now. It's very helpful to get your feedback so we can improve our presentation for the future. And I'd like to leave you with a few remarks is make sure you have a financial plan. Make sure you understand it. You have that trusted advisor that you can ask all these questions to. And once you have that well-designed plan, stay disciplined in your approach. These are some key elements that will help your success in your portfolio now and into the future. If you have any questions for Adam or myself, please send us an email, call us. We'd love to hear from you, answer any questions you have now or in the future. And if you're also interested in any of our upcoming webinars or any additional information, articles, videos that we send out, please also send us an email and we'd be happy to send those to you. So thank you so much. Enjoy the rest of your day. Stay safe and healthy.
Thank you.